presentation contains current opinions of Moise Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Mo's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Mo.
Hello everyone, and welcome to the Compak YouTube update for March the 4th, 2024. I'm Mo Ansari, President of Compak Asset Management, and don't forget to subscribe to all of these services, the YouTube update, the weekly podcast, the weekly newsletter, so one-pager, and also all the webinars and the seminars that we do. All of this is all free. All you have to do is go to compak.com/media, and don't forget to subscribe to this. Click on the subscribe button, and you can get this YouTube update every week. Whenever I do it, you'll get notified immediately that it is up there, and you can go and see all of what I'm looking at, what I'm thinking about. Looking at last week, S&P gained another nearly 1% for the week, continues to make new all-time highs. I love saying that whenever we do that. And the small caps had a wonderful week last week, up 3% for the week. NASDAQ was up 1.76%. So it was a good week overall. Technology continues to lead the week with about a 2.5% gain, and for the year also 12.5% gain. Utilities are the worst because as interest rates go up, utility values come down. So that has not done as well for the year. Healthcare was the worst sector, so the defensive sector's not doing as well. Oil prices were up again for the week, nearly $7 a barrel. Again, due to the heightened problems in the Red Sea with the Houthis attacking the shipping lanes there, and one of the ships were sunk. But there is more talk of a ceasefire in Gaza. If we do get a ceasefire in Gaza, I think that will be negative for the oil market, even though OPEC did increase to extend its cuts in oil production, and that they have reduced their production, but they are still holding on to the same numbers, which does not change anything. Oil is down today because of this. I think our production continues to go up here in the United States. Looking at interest rates, 10 years were down last week to 4.19 from 4.26. And this is about where we are. I think we're going to stay here. The big news is going to be the events this month. CPI, I believe, is going to be the big number this month. That's the consumer price inflation number. That's going to come out mid-month, about on the 12th. And then we have the FOMC meeting. The Fed is going to announce what they're going to do. Obviously, there's a very high probability that they're not going to make any changes to interest rates. The big question is, what are they going to do in June? What are they going to hint? But looking at the economy right now, it continues to do well, even with interest rates where they are. Inflation, I think the numbers, if it come out, and there's a chance that the number can come out a little bit hotter than expected. We had the January number, which was a little bit higher in inflation, February number. We're getting into the part where reducing inflation is going to be difficult in the short term. So we could see some more volatility because of that. And if we do get a higher inflation number, the Fed might say, well, the market might say, well, the Fed is not going to cut interest rates anymore. I think that's going to the other extreme from where we were 4 or 5 months ago, where there was the expectation that the Fed is going to cut interest rates 6 times. I still think they're going to reduce interest rates about 3 times this year. When and by when they're going to do that, that's the big question. Are they going to start in June? If they don't, then they get closer to the election, and they'll be accused of being political by cutting interest rates and so on. And they don't want to really get into the middle of that. So I think they might start a little bit earlier if they see that there is room. But if inflation remains sticky, which it is at this point, remaining pretty sticky, a lot of it is due to shelter, which is a big part, and automobile insurance. Those have been the 2 big factors that have pushed up the CPI that we saw last month. But now for February, when we get the number in the middle of March, that should give us some more indications. Looking at the yield on during the prior tightening cycles, inverted yield curves, historically 10-year peaks, about 20 to 25 basis points below Fed fund rates. So that's where we were. We were at 5.3. The Fed fund rate, 10-year was at 5%. So that's historically where we've seen a peak in rates. But I think we've already seen the peak in rates, and that's the chances of them raising interest rates is small. New home sales increased by less than expected, 661,000. PC rose 0.3. That was in line with expectations. Data we got Core PC up 4, slightly above consensus. That's what we saw. Job openings comes out, non-farm payroll comes out on Friday. Unemployment rate is something to watch. And then next week we get the CPI, and that is going to be a big number that we have to watch for this week. I think we could see some volatility with the numbers coming out on the unemployment. On March 13th, we are going to do a webinar. Make sure you sign up for that. It is free. Tax Time webinar tells you some of the tax strategies that you can employ to reduce your taxes. Looking at the S&P chart, continue to move higher. We made new all-time highs. Support now at 50.31. We are trading right around 50.30. That's where we are now. And then we are at, or it should be 49.31, I think. No, 50.31 is where we are right now. And so I think that's going to be the support area, 20-day moving average, and 48.94, the 50-day moving average. And then we have, so this is all wave 3. That's what this has become. And this is wave 3. We are going to get a fourth wave pullback somewhere. When that's going to start, I think we'll have to wait and see. Looking at the number for the long-term weekly charts, each one of these lines is 1 week of trading, the vertical green and red lines that you see. The target was 50 to 51.50. We are right there in that zone. And if we get much above this 51.50 area, then I think we could, we're just breaking out. Then the target really becomes 55, 5,600, somewhere right around there. But we have not gotten above 51.50 right now. We're trading around 51.35 or so. And that's where we are. NASDAQ continues to move higher in the fifth wave. We did get a big move up on Friday. Support now 15.4. That's where we are. We're trading at 16.2. We did get above, make new all-time highs for the NASDAQ. Looking at the weekly chart, this is 16.2. We've got above that 16.212. We're trading right around the 16.6 now. That's the area we're in. 16.264 is where we are. But we got above the 16.212, new all-time high. So now the target is 17.1 to 17.750. That's the projection, Fibonacci projection from this high that we made in 2021. So it's been a couple of year wait, but we are headed towards, we already made new all-time highs, but that's the Fibonacci projection. 10-year yield down big on Friday, sitting right at the, right above the 200-day moving average, which is 4.17 or 4.18. We're trading around 4.225 today. That's where we are. So still a little bit higher, but that's still a fourth wave. But we've used a lot of this opportunity. If we break below 4.17 or really get below 4%, 4.1, then I think we could be starting a new wave to the downside. But we haven't seen much. We've been in this sort of range right here of 4.4 to about 3.8 and just going back and forth in this range. Looking at crude oil prices, down big today, down about $1.26, 71.81 is the 200-day. We're trading around 78.54 last trade that I saw. If we can break below this, which I think we will, once we get a ceasefire in Gaza, which could be very negative for the oil market. Looking at small caps, they continue to move higher. My target 208 to 210. That's the Fibonacci projection. That's what I put up a couple of months ago. We are at 207.77 today. So we're 206.47. High was 207.77. So this could be, we could be very close to getting to that target, 208 to 210 that I had outlined. That's my technical view this week of the markets. For more detailed analysis of what I'm thinking, tune into the podcast. That's about a 45-minute update that we do where we talk about the fundamentals, the macro picture, what is going on with the economy, what is going on with the markets. Javed and I will both join you on the podcast, so make sure you subscribe to it. It's absolutely free. Those are my thoughts. Those are my observations for March the 4th, 2024. I hope you have a wonderful week. I look forward to seeing you next week. Until then, good trading.
presentation contains the current views and opinions of Moise Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compak Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that over-focus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.